Hey everyone, and welcome back to the channel. Today, we are going on a financial adventure to look at a company's financial health. Think of it like a doctor's checkup. We want to peek behind the curtain and see if a company is financially fit and strong, or if it secretly needs to hit the gym. And later, I'll share a surprising story about a famous company that breaks all the rules. It will definitely change how you look at financial metrics. You know our motto, if it's complicated, let's break it down. First, Sophie asked Video Tutor to create a quick 2-minute AI-generated explanation of 3 key metrics to look at on companies' financial health.
Financial health in fundamental analysis refers to the overall strength and stability of a company's financial position. It measures how well a company can meet its short-term obligations, manage long-term debt, generate sufficient cash flow, and sustain operations over time. Strong financial health indicates lower investment risk and better ability to weather economic challenges. The current ratio is a key liquidity metric that measures a company's ability to pay its short-term obligations. It's calculated by dividing current assets by current liabilities. A ratio above 1 indicates the company has more current assets than current liabilities, suggesting good short-term financial health. For example, if a company has $150 million in current assets and $100 million in current liabilities, the current ratio is 1.5, indicating strong liquidity position. The debt-to-equity ratio is a crucial solvency metric that measures a company's financial leverage by comparing total liabilities to total equity. It shows how much debt a company uses to finance its assets relative to shareholder equity. A lower ratio indicates lower financial risk and less dependence on borrowing. For example, a company with $200 million in liabilities and $300 million in equity has a DE ratio of 0.67. indicating moderate leverage and manageable financial risk. Free cash flow conversion is a critical metric that measures how effectively a company converts its reported earnings into actual cash flow. It's calculated by dividing free cash flow by net income. A high conversion ratio indicates quality earnings backed by real cash generation, while a low ratio may signal issues with cash collection or aggressive accounting. For example, if a company has $80 million in free cash flow and $100 million in net income, the FCF conversion is 80%, indicating good earnings quality. In summary, financial health analysis uses 3 key metrics to assess investment risk. The current ratio measures liquidity and short-term payment ability. The debt-to-equity ratio evaluates leverage and long-term financial risk. FCF conversion assesses the quality of reported earnings through actual cash generation. Together, these metrics provide investors with a comprehensive view of a company's financial stability, helping them make informed investment decisions and identify potential risks before they become critical issues.
Okay, let's put a real company to the test, Apple. You can see more analysis like this on sophie-ai-finance.com. When we run the numbers for Apple, Apple's current ratio is about 0.8. That's way below our 1.5 safety mark. Its debt to equity is almost 1.5. That's nearly 4 times more debt than equity, blowing past our safe level. But wait, its free cash flow conversion is a rock-solid 101%. So what gives? 2 of our key metrics look terrifying. Is Apple secretly in deep financial trouble? Actually, no. And this is where we look beyond the numbers. For a company as unique as Apple, the traditional rules don't tell the whole story. You have to ask why. That low current ratio? It's not a weakness, it's a sign of incredible power. Apple has a negative cash conversion cycle. In simple terms, it gets cash from you for that new iPhone long before it has to pay its suppliers for the parts. It's so efficient, it doesn't need tons of cash just sitting around. And that sky-high debt-to-equity ratio? Is Apple drowning in debt? Nope. This is a deliberate strategy. Apple makes so much cash, it doesn't need to borrow. Instead, it borrows money at super low interest rates and uses it to buy back its own stock. This makes the equity part of the ratio shrink, which makes the number look huge. It's not a sign of trouble, it's financial engineering to boost returns for investors. So if those 2 ratios are misleading, what's the real test? It's that last one, the free cash flow. That is the engine, the ultimate proof of health. Apple's ability to turn its profit into pure cash is the superpower that makes everything else possible. It's the fortress protecting the entire kingdom. See how confusing that can be? These metrics tell the truth for most companies, but they can lie about the special ones. Either the company is like Apple, really exceptional even on structuring the company's financials, or maybe it is just a real lie. Context is king. So what are the takeaways today? Let's do a quick recap of our new tools. First, we have the current ratio, or can they pay the bills? Check. It's a quick look at a company's short-term health. Second, the debt-to-equity ratio. This is our how much do they rely on debt meter. It's a key check for risk. And third, the king in the castle, free cash flow conversion. This is our show me the real cash test, the ultimate proof of a company's profitability. For most companies, cash is king. A business that gushes real spendable cash can make its own rules. But the biggest lesson is this. While these metrics are a great starting point, numbers without context can be deceiving. Always ask why they look the way they do. And be careful when asking an AI about these metrics, as it might not understand the deep context and could give you a misleading answer. That was a deep dive. What do you think? Let me know your thoughts in the comments. Visit SOPHIE-finance.com for all the details. It is completely free dashboard, no login, no subscription, need nothing from you. It is my personal hobby website. And as always, if you found this helpful and want to see more breakdowns, don't forget to like, subscribe, and hit that notification bell. Until next time, keep decoding and remember, if it's complicated, let's break it down.